So this week we're going to talk about multiples, also known as comparables or comparables, depending on how you want to pronounce them. But the general idea here is it's an alternative form of valuation. So originally this week we were going to do a cash flow valuation. And the idea is a company's worth the sum of its future cash flows. So we were going to build an Excel model to predict the future cash flows, and that was going to get us an intrinsic value of the company. Okay? Now, multiples are a reverse process. What we do is we start with the value of the company, and we work backwards to figure out the cash flows, right? But as an alternative form of valuation, what's important to understand is just because we change our methodology doesn't mean the company's value should change. There's one value to the company. And all of these methodologies are just rearranged equations and slightly different approaches. But we still have to come up with the same answer. So part of what we will use multiples to do is to help us triangulate the multiples answer for the companies that we are valuing. And again, the approach is the multiples start with actual prices of a company in the marketplace, and then we work backwards to figure out what it tells us about a stock price, as opposed to predicting the cash flows, which lead to the multiple by leading to the stock price. All right, so we get to the same place, it's just where we're starting. Now, Wall Street likes multiples for three reasons. Number one, unlike cash flows, which are some theoretical value based on guesses of what the cash flows are going to be, multiples are based on actual prices. Right? So people like multiples because they're based on observable prices of assets in marketplaces as opposed to fairy tales in spreadsheets. Now, eventually they have to equal each other, but people like the idea that there's something tangible about an observed value that gives them comfort. So that's one reason why people like multiples. Second reason why people like multiples is that, again, it's based on actual observable data, which means that we can work backwards to figure out what the cash flows are. So the multiples help us do the cash flow analysis that we're going to do. And third, they're easy, right? Figuring out the cash flows are hard. Figuring out the multiples are easy, right? And Wall Street likes easy. And by the way, I'll throw a fourth one in there. You're less likely to be sued. Because if you do a valuation based on a DCF, it's based on, again, all these theoretical assumptions. If you do it based on actual prices, then it's harder to say that you made up the math. Okay? So, because you're using it based on justifiable numbers that other similar assets are trading at. So it also protects them for legal reasons. But inevitably, you're going to do both if you work on Wall Street or work for a bank. So what is a multiple analysis? It basically says looking at other assets of similar price to help you figure out what something is worth. That's the idea of a multiple analysis. And it's useful not only for public companies, but private companies. Matter of fact, there's a related multiple concept called precedent transactions, right? So multiples are also used in M&A. Okay, so if I want to do an M&A, I look at multiples. What has been paid for other companies that were acquired? That's called a precedent transaction. Or I want to do an IPO. What has another company's IPO been done at? Or if I want to just raise financing and I'm a private company, then how do I value the private company? I look at what public companies are trading at as peers, and I do that as comparables. Matter of fact, another very valuable feature of Bloomberg, Tim Cook said something they didn't like, is if you go to the M&A section of Bloomberg, short code MA, this will show you all the recent deals that have been done. Any merger, any acquisition, any type of financing, and like the equity screening tool, you can screen down. But for example, here is something where Alcoa is buying this company, RTI International, for $1.5 billion in stock. So if I click on this deal, then here's all the information about the deal. And one of the things I can look at are the deal comps. So here are similar companies to this one that have been acquired, when they were acquired, and then here are their multiples. TV is total value, so total value or enterprise value to EBITDA, enterprise value to EBIT, enterprise value to sales, enterprise value to assets. So again, I have a precedent for the transactions that have been made. So these are used all the times in deal values. Right? Matter of fact, I was telling the previous groups that I have a private firm. I wanted to issue some stock options. The IRS says if you're going to issue stock options, you have to have them at fair market value. So I had to get a fair market value of my private company. Now, this is something that I could have done in 10 minutes using a data service like Bloomberg, but I'm not qualified to do that with the IRS because I haven't filed the paperwork, and at the same time, I work for the company, so I would be perceived as biased. So I had to hire a third-party firm to do something that I could have done pretty quickly. So what did they do? They asked me for a forecast of financial statements for next year. I gave that to them. They looked at our historical financials. Then they found comparables. They found a bunch of firms. They use enterprise value to EBIT. They basically looked at the enterprise value of the EBIT of the peer firms. They multiplied that by my forecasted EBIT. They came up with the value of the firm. They then multiplied that number by 60%, and they said that was an illiquidity premium because I'm a private firm with non-publicly traded stock, and that was the number they gave to the IRS. So, or gave to me to give to the IRS if it's ever challenged. But basically, it's no different than doing the type of analysis we're going to be doing here today. Now, back to multiples. The key to multiples is to find a similar range of companies. And though that works very well in an academic setting, you will be challenged with this in the real world. Because finding the actual comparables is really hard. And I'll give you an example of this. So on Friday, I was doing some work with Google, and I was showing them their data against Facebook, who they wanted to see. But then they were asking about LinkedIn. Then they were asking about Yelp. The problem is Google, which is a $60 billion company, and Yelp, which is yet to see $1 billion worth of sales, it's kind of hard to say they're truly comparable because they're far different sizes, and they have far different growth trajectories. Matter of fact, they have far different businesses. I mean, Yelp isn't building self-driving cars. Yelp isn't building wearable technology. So we're comparing these companies, but they're not truly comparable. And that becomes the problem, is that how do we find companies that are truly comparable? Matter of fact, another company I do work with is called Ingersoll Rand, and I think I referenced them earlier this semester. And their primary business is heating and air conditioning. In fact, their primary competitor, it's called Trane, is their brand, is Carrier. Well, Ingersoll Rand makes air conditioners, they make locks, and they make golf carts. And their primary competitor, United Technologies, makes air conditioners, helicopters, jet engines, and elevators. Right? These companies are compared, yet if you think about their businesses, they have nothing to do with each other. And that's the problem in the real world. So every now and then, you get a UPS and a FedEx. Every now and then, you get a Home Depot and a Lowe's. But most of the time, Disney. How do I compare Disney? Well, do I compare them against a Six Flags? Do I compare them against a Hollywood studio? Do I compare them for, other types of their empire, their printing or Disney cruise ships? So basically, it becomes harder to do comparables. But that's the key. So how do we find comparables? Well, what matters, and these are key to best practices, is we actually want to find companies that have similar expected growth rates, similar ROICs, and similar capital structures. That is what's going to matter more than anything else. So, what are the steps to do a multiple analysis? Number one, finding a good peer group. That's hard, but that's the first step, finding true peers. Second, I got to go get the data. Now, in this class, we're going to care more about forward data, forward multiples, than historical multiples, because a company's worth the sum of its future cash flows. So I don't care about the historical cash flows. I care about the expected cash flows. So I need a professional data service like a CapIQ or a Bloomberg to get the forward numbers. I can't do a good multiple analysis with Yahoo Finance or Google Finance because they don't have any forward information. The pros are using forward multiples. We're going to use those as well. Then we got to calculate the forward multiples and then compare them and understand that there are distortions that can be done by the multiples, and what are those distortions, so we can get an understanding of why are companies trading at a premium or discount and what range of multiples a company should trade at. So that's kind of the process that we're going to go through. Best practices. You want to find companies that have similar growths and ROICs. You want to use forward-looking multiples. You want to generally use enterprise value multiples wherever possible because they're less prone to distortion. And you got to be aware of things that will distort a multiple, particularly non-operating items, difference in tax rates, difference in capital structures. Matter of fact, the most commonly used multiple, price to earnings, which is the one that you were previously taught and the one that is most intuitive to most people, is actually the most difficult multiple to explain, right? And the reason why is price to earnings, earnings per share, is based on net income. Everything above net income influences net income. So price to earnings multiples are a 6-factor analysis. Price to earnings multiples are going to be influenced by growth, return, cost of capital, tax rate, capital structure, non-operating items. Every one of those can influence a price to earnings ratio, which means when we're trying to explain price to earnings multiple differences across firms, we got to talk about all 6 of those items. That's what actually makes price to earnings the hardest multiple to explain. That's why the pros like enterprise value multiples. This semester, you're going to work on explaining 6 multiples. These are the 6 commonly used multiples that you are going to have to understand. The first is the price to earnings multiple. Price per share divided by earnings per share. What that does tell you is for $1 of earnings, what is the market value of $1 of earnings? Okay? And again, it's a 6-factor analysis. The second multiple is called the PEG multiple. The PEG takes the price to earnings multiple and it divides it by the expected growth rate. Now, in this case, this G in the PEG is not the same G in the key value drivers equation. That G is the perpetuity growth of free cash flow. In the PEG, the G, the convention, is the 5-year growth in earnings per share. Okay? So it's a different growth rate. Right? But what it does say is for a growth in earnings per share, $1 of earnings per share, how much am I willing to pay for that growth? Higher PE, lower PE. So, a high PE means I'm willing to pay more for the earnings than a low PE. So a high PEG, growth is more valuable. For a low PEG, growth is less valuable. From the key value drivers, we know growth and spread are critical. So that's the point. What am I willing to pay for the growth? Why would I pay more for growth? More spread, more ROIC. So PEG, more than any ratio, gives you insight into expected ROIC. The next 3 ratios are the enterprise value ratios. The enterprise value ratios are less susceptible to distortion than the PE ratio. The first one is enterprise value to sales. How much am I willing to pay for $1 of sales? What you're going to find out today is that is a proxy for a company's margin. Higher margin, higher enterprise value to sales. Lower margin, lower enterprise value to sales. Enterprise value to EBIT and EBITDA. How much do I pay for the core earnings of the company? Those are the operating earnings. Again, 2 important multiples. And finally, price to book. Price to book says for every $1 of equity, what is the market value of that $1 worth? A price to book of 1 means the equity that I put in is worth exactly $1, which means my company's NPV 0, which means I have 0 spread. A price to book above 1 means my company's NPV positive, which means I have a positive spread. Price to book below 1 means that I have a negative spread. So price to book is the cleanest ratio for spread. PEG is ROIC. So here's the problem. Price to book is also one of the most distortable ratios. So we got to be careful because the accountants are constantly making adjustments to equity. That's the book in the price to book. So theoretically, the price to book tells me about the spread, but if the accountants have been adjusting the equity, it could distort that. And I'll give you an example of this. In the defense and aerospace industry, if I look at a company like Lockheed Martin, and I look at their multiples, these are the multiples from class, and this is the price to book multiple of Lockheed Martin, 18.47. Most companies' price to books are going to be like 1, 2, 3. Theirs is 18.5, right? Why is it so high? Well, you got to go back to 2008. Lockheed Martin and most of the defense companies have been around for 50 years. So one of the things that Lockheed has is they have a lot of employees on pensions. They don't have 401ks. They just started switching to 401ks. So Lockheed promised to pay the pensions, and they have a lot of money invested in pension assets to fund their pensions. Well, in 2008, stock market crashed. Remember Dow 6000? When the stock market crashed, the value of their pension assets dropped dramatically. Lockheed Martin had to go in and write down the value of the pension assets. They also had to write off the equity to reflect the write down of the pension assets. Wiped out a bunch of equity. One-time accounting change. Since then, the stock market's gone from Dow 6,000 to Dow 19,000. So the market's gone up dramatically, or 18,000, wherever it is today. But the point is, stock market's tripled. Well, here's the thing. The accountants don't let you write up the value of your pension assets. So in 2008, they wiped out a bunch of equity. Market value of Lockheed Martin's gone up dramatically. Equity value is almost non-existent because they wiped it out. They can't write up the value of the equity, so they got an extreme price to book. So in this case, the price to book's not high because of their spread. In this case, it's because of an accounting distortion. And that's the one challenge with all of these multiples, is they're based in accounting, and accounting can distort them. And so we're going to have to be careful when we look at these multiples to figure out if they're telling us the actual story or if they're telling us a distorted story. And price to book is one of the ones more easily distortable. But if it's not distorted, it's a great ratio because it tells you about the spread. So, here's the thing. Just as a quick example. Here's Citi, and I know we're not going to do banks, but Citi's been in the news because of the stress tests. Here is the price to book of Citi. Today it's 0.8. Average big U.S. bank, 1.27. What does that tell you about Citi? And what can we say about the U.S. banks? What can we say? U.S. Bank's price to book is 1.27, Citi's 0.8. What's that tell you? Because this is your next graded homework assignment. What do you think? Yeah.
That the book value of their assets are higher than the actual market price of them.
That's for the average bank. Citi, the book value of the assets. Oh, sorry. Citi, the book value of the assets for Citi is higher than its assets. Why? What can we say about Citi's spread?
It's lower than average.
Not just lower than average, it must be negative. I'm worth more dead than alive. I put in $1 of equity, that equity is worth 80 cents. Why is it worth only 80 cents? Because I have to have a poor return on my capital. Citi has a negative spread. All right. Average U.S. bank is 1.27. Average investment bank has a positive spread. That's the way you need to start looking at these ratios. That's what I said. The ratios are telling you the story. So when you're looking at the numbers, you got to understand the story that it's actually telling you. As I was telling the other classes, it's like if you watch The Matrix and you see the green stuff coming down the screen, like they're looking at that, and they're not just looking at green crap going across the screen. They're actually seeing a story that's being told. You're going to have to get good at seeing the story behind these numbers that other people aren't seeing, because there's a lot of data hiding in plain sight if you know how to interpret it. And that's one of the things that we could quickly interpret is here's a proxy for the spread in plain sight. Right? So let's talk about these multiples in more detail. I'm going to start out with our key value driver equation. So if you remember our key value driver equation, which is the one you just went over again and we did on the midterm, this was the key value driver equation. And the idea of the key value driver equation was that a level of profit and a cost of capital for different ROICs and different growth rates, you get these results. Well, what is enterprise value to EBIT? If you put in the key value driver equation, you get the enterprise value. If you divide by EBIT, you get the enterprise value to EBIT. So a higher enterprise value to EBIT is more enterprise value. What's more enterprise value? It's ROIC and growth. So enterprise value to EBIT and enterprise value to EBITDA are approximations of growth and spread. Right? Assuming similar cost of capitals, growth and return on invested capital. So that's why the bankers like them, because it's basically looking at the expected ROIC and the expected growth rates primarily for firms in an industry which have similar cost of capital for those companies as the key drivers, because these were the key drivers of the enterprise value multiple. Now, the one thing is this also assumes that the company doesn't have a lot of non-operating assets, right? So if that could also distort it, but again, without non-operating assets, that's the enterprise value to EBIT and therefore EBITDA. So how does this differ from the price to earnings multiple? Next ratio. Enterprise value to EBIT is based on free cash flow. It's the no-plat after the reinvestment. Well, the price to earnings ratio is based on the net income, the earnings per share, which is the cash flow just to the equity holders. All right? So the no-plat is the cash flow to the debt and the equity holders. The net income is just the cash flow to the equity holders. So what we do with the key value driver equation is the value for the equity is the market cap, not the enterprise value. The cash flow to the equity holders is the net income. The growth is the growth in the net income. So it's not the growth in the free cash flow, it's the growth in the net income into perpetuity. The return on the invested capitals, the return on the debt and equity, in this equation becomes the return to the shareholders, which is the return on equity. And the cost of capital, the WACC, is the risk of the debt and equity. If I just care about the equity cash flows, it's just the cost of those equity cash flows, cost of equity. So I can use the exact same key value driver equation to get a price to earnings multiple by making these substitutions. So no-plat becomes net income. Growth becomes growth in net income. Return on invested capital becomes return on equity. And WACC becomes cost of equity. And value becomes market cap. All right, the market value of the equity. And then the multiple becomes the PE. Right? So I can actually use the same equation, just those different terms, and that gets me a PE. So I wanted to look at McDonald's. So let's look at McDonald's. Ticker symbol MCD. So I'm going to go to McDonald's. And the first thing I'm going to do is I'm going to notice that right now their market cap is $94,180,000,000. So actual 94,180. Actual. Okay. And if I go to the EEO screen, all of the multiples that we're going to calculate in this class are right here already calculated for you. So Bloomberg knows that these are what the pros are using. That's why we're doing them. And here they are. Now, what we care about and what you're going to see in the reading, and I know some of you haven't gotten to the reading yet, but because it was supposed to be for after the spring break, but one of the things it's going to talk about is how we care about the second forward year. Okay, that is more normalized. That's what the pros are focused on. In that case, forward year 1 for McDonald's, 2015. Forward year 2, 2016. So what we really care about are their 2016 results. Right? Now, for McDonald's in 2016, net income is the adjusted net income, right, as opposed to the GAAP net income. And this is actually one of the changes that Bloomberg just made, because we are trained as analysts to ignore non-cash accounting charges that the accountants put in the GAAP earnings. And we're trained to ignore one-time gains and losses. We want recurring things. So that's what adjusted net income is. So the analysts actually look at not a PE, but they look at what's called an adjusted PE, the price to the adjusted earnings, where you take out the one-time gains and losses and the non-cash accounting charges. So that PE for 2016 is 18.11. That's the actual PE. And that is based on net income of $5,018,000,000. I'm going to solve for the long-term growth rate, which is what your next homework assignment is going to be when you do this on Wednesday in class. Return on equity, like we've done before. Look at the next 3 years to get an average. 36, 40, 46. I'm going to call that 40. I'm just going to quickly eyeball it. So that's about a reasonable return on equity going forward. Cost of equity, I get off the WACC screen, WACC. 7% cost of equity. So, using our formula, that would give me a value of about 71 billion. And that would give me a PE of about 14 with no growth. So let's start growing. 1%, 2%, 1.7%, 1.73%. Somewhere around 1.71%, the PEs match. So using our key value drivers formula, I got very close. Now here's what's interesting. My market value is off by about $3.3 billion. Why? Why wouldn't my PE and my market cap actually match? And I'll give you a hint. Operating value is what we're solving for here. So what are we missing? Operating value plus what equals enterprise value? What are we missing? We're missing the non-operating value. What's a big non-operating asset that just about every company has? What's McDonald's probably have a lot on the balance sheet on the asset side? It's a non-operating asset. You just did economic statement conversion. What's over there in the non-operating bucket? Goodwill could be one, although that's operating.
Excess cash.
Probably some excess cash. How much cash do you think McDonald's has on their books? Excess cash. If you had to guess. Look at the numbers on this spreadsheet. What's the difference? What's the difference between these two numbers? 3.3 billion? Excess cash. If we go, when we look at McDonald's, FA, and we go look at their balance sheet, they have $4 billion worth of total cash. Take out some operating cash, that's your difference. This is what I mean by distortions for non-operating assets. right? Because we could either solve for the exact value, but then we'll get a distorted PE, or if we look at the operating PE, then what we're missing is the non-operating asset. And so this is where if companies have different levels of cash, it will actually change their valuations. So what we often do is we assume that they don't, right? So what I could have done is I could have taken McDonald's market cap and I could have subtracted the $3 billion worth of cash, and then I would have gotten pretty close to the operating value of McDonald's. Because that's the point. What am I buying when I buy the stock? I'm buying $3 billion worth of cash plus their operating value. Okay? Now, that's the PE multiple. And that's the growth in the earnings per share for the next 5 years. Right? So, why, when I go look at the multiples, is McDonald's trading at a little bit of a discount to some of its peers? I start to get a sense. Do they have an ROI problem, return on investment problem? What's McDonald's problem? It's going to be a growth problem. I'm already starting to see that in the multiples. Okay? So, next multiple. Again, ROE is the net income, key value drivers, gets me a value, equity value, price to earnings, just divide by the net income. These are the PE multiples. Price to book, related to PE. Again, high PE, high price to book. Low PE, low price to book. Spread drives price to book. Now, again, the reason we like enterprise value multiples is they're less susceptible to some distortions, particularly difference in capital structures. Basically anything below EBIT. So let's talk about enterprise value to EBIT. Can we use the key value drivers formula to get to an enterprise value to EBIT? The answer is yes. This is how we actually get to enterprise value to EBIT. We start with our key value drivers, which is NOPAT times 1 minus G over ROIC divided by WACC minus G. We say that NOPAT is EBIT times 1 minus the tax rate. We divide both sides by EBIT. Value to EBIT, enterprise value to EBIT, is 1 minus the tax rate times 1 minus the growth over the ROIC divided by the WACC minus the G. So what are the real drivers of enterprise value to EBIT? Differences in tax rates, differences in growth rates, differences in ROIC, differences in cost of capital. So tax rates do matter. Okay? So let's look at the enterprise value to EBIT for McDonald's. How do we get that? Well, we're going to need a couple pieces of information. One, we're going to need to know, we need to know their expected EBIT, and we need to know their effective tax rate. So for 2016, the EBIT for McDonald's, right out of Bloomberg, off the EEO screen, is expected to be $8,044,000,000. So 8044. For the effective tax rate, I can go to the FA screen. I can go to the custom area, and I can just type in effective tax rate. Here's 5 years of historical, or 6 years of historical tax rates. 30, 29, 31, 32, 32, 35. Right? So considering last year is a little higher, I'll just say 32%. Kind of eyeballing those. I think McDonald's is going to pay about a 32% tax rate going forward based on the last 6 years. Okay? Now, what else do I need to know? I need to know the EBIT, I need to know the tax rate, I need to know the G, I need to know the ROIC. Here we have to go back to the RV screen, just because Bloomberg won't let us use the custom field in the FA screen. It's annoying, but that's what they do. So if I add a column here, operating ROIC, from our custom fields, Operating ROIC for McDonald's was around 19%. Right? Now, their ROE was ticking up a little bit. So let's say that I think their ROIC ticks up a little bit, and I'm going to call that 20%. And finally, I need a WACC. McDonald's WACC, 6.2%. Now I'm ready to solve for their enterprise value. Assuming a growth rate. We're going to solve for the growth rate again. So, their actual multiple, EEO, that I'm trying to get close to, EV to EBIT is 13.3. So what is the formula? Basically going to put in this formula. So 1 minus the tax rate. I'm going to multiply that by 1 minus the growth divided by the ROIC. I'm going to take all of that and I'm going to divide that by the WACC minus the G. So that would tell me that the multiple would be 11 with no growth. So back to 1%, 2%, 1.5, 0.48, 0.47, somewhere in that range. This is what I mean by hiding in plain sight. What we now know, just by looking at the multiples, is we know that McDonald's is going to grow somewhere around 1.5% going forward. Economies around the world are growing at 3+% long term. They have a growth problem. It's showing up in their multiples. It's showing up in their numbers. Matter of fact, Bloomberg's got this really cool thing called retail comps. And what we can see is that McDonald's has been actually seeing their same-store sales decline. That's the problem, is the market is basically seeing same-store sales declining. That was the article in the Wall Street Journal over the weekend. And if you look at the multiples that they're trading in the marketplace, it's reflective of lower expected growth long term, which is why their stock price is challenged, which is why their previous CEO was fired. Okay? This is the story that you will be able to tell for your next graded homework assignments and throughout the semester. Finally, enterprise value to sales. How do we get to an enterprise value to sales multiple? Well, again, we'll start with our key value drivers, and we'll get to enterprise value to sales. What do? Well, NOPLAT is revenue times EBIT times 1 minus the tax rate over revenue. Divide both sides by revenue. So enterprise value to revenue is basically going to be our margin, EBIT over revenue, times 1 minus the tax rate times this, divided by that. This, 1 minus the tax rate and all this, is enterprise value to EBIT. So enterprise value to revenue is the estimated EBIT margin times the enterprise value to EBIT multiple. So basically, what is my estimated margin? It's my enterprise value to sales divided by my enterprise value to EBIT. So let's take McDonald's. Their EV to sales right now for Mickey D's 2016 is 4.14. Their margin equals 4 divided by the 13.3. It's 31%. The market is expecting a 31% margin from McDonald's. That's the other gem that's hiding in plain sight. So when we do our valuations, we got to figure out what the long-term margin of the company is going to be. The market is using 31% for McDonald's. That's going to be a key insight when we develop our valuation models. Right? So again, EV to sales is sensitive to margin. Matter of fact, if I look at one of their competitors, let's look at Yum. Who is Yum? Company Yum, Y-U-M, ticker symbol. Yeah.
It's like KFC and Taco Bell.
KFC, Taco Bell, Pizza Hut. They were a spinoff from Pepsi not too long ago, PepsiCo. So let's look at Yum. If I go to the RV screen, I can look at these multiples for the peers. Yum, where's Yum? Leave it on this list. Bloomberg peers. There we go. EV to sales 2.42. EV to EBIT 14.69. Expected margin of Yum 16%. McDonald's has great margins. McDonald's has great ROIC. Premium or discount. Yum trades at higher EV to EBIT than McDonald's. I'm willing to pay more for Yum's earnings and about the same EV to EBITDA, even though Yum has lower margins. Why? What would explain that? What does Yum have that McDonald's doesn't? And I'll give you a hint. Look at these PEG ratios. Who has the higher expected ROIC, McDonald's or Yum? Look at these PEG ratios. Higher PEG equals higher ROIC. Who is the higher expected ROIC, McDonald's or Yum? McDonald's has higher expected ROIC. McDonald's has almost double the margins. Why are they trading at a discount to earnings of their peers and of the industry? It's one number. It's the growth. Here's a proxy for this. The growth in earnings of the industry is 13%. The growth of McDonald's is 8%. The growth of Yum is 11%. So that's the point. They don't have the growth. They have the negative declining same-store sales and therefore the growth problem. That's what's happening to their multiples. So McDonald's is a great company. They know how to make money. They just can't get people to buy their damn food. That's the problem that they're having because people are saying, you know what, it's unhealthy, I'm going to go someplace else. And so that's the challenge that McDonald's has today, showing up in their numbers. Notice we didn't do a single DCF. Yet, we got a lot of insight. This is what you need to learn how to do. You need to look at multiples and you need to go beyond the naive stuff that you were previously taught. You were taught that you just average it out and multiply that average by an earnings, and that's the company stock price. No, it's not the way it works in the real world. The way it works in the real world is there are factors that drive multiples. It's the growth rate, it's the margins, it's the returns, it's the cost of capitals, it's those non-operating items, to some degree it's the tax rates. That's what you can see that the market is actually giving you that data that they're using in their assumptions in the multiples. And that's what we're going to be able to pull out of the multiples. And that will make us better when we do our cash flow valuations. Because then we can decide if we agree with them or not later, but at least it gives us a baseline for how these companies are actually being valued. So finally, premium or discount. Premium means the company's trading at a higher ratio, higher than the average, higher than its peer. Discount means it's trading at a lower ratio than its peer. Okay, so let's go McDonald's against market cap weighted average. You have two data points for EV to sales. What does that tell you? Now that we know what we know, what does that tell you about McDonald's versus the average of these companies? McDonald's is at a premium to EV to sales. What does that mean? Why? What can we most likely say about McDonald's? EV to sales tells us what? That's the profit margin one. Who has the higher profit margin? Average company or McDonald's? Probably McDonald's. So we know that McDonald's is probably a higher margin firm. How much higher? We could do the math. But that's the point. We can immediately see McDonald's is a higher margin firm. All right? Again, EV to EBIT, EV to EBITDA, lower than the industry average. PEG, higher than the industry average. So what does this tell us about McDonald's? What drives EV to EBIT and EV to EBITDA primarily? It's growth and spread. What do we know about the ROIC? Likely higher at McDonald's. What do we know about the growth rate? Lower growth rate. That is McDonald's challenge. All right. So McDonald's challenge goes back to growth, and you're seeing it in the way that they're trading in the multiples. As I said, this is the data that you need to start gleaning out of a company. So, as I said, I will show you something that made me look really smart about a month ago when I was standing in front of PVH. And I wasn't really just being smart, I just do the data in front of me. Okay? So I'm going to show you the same thing. So, talking to PVH. Who's PVH again? Told you earlier this semester. It's two brands. It's Tommy Hilfiger and Calvin Klein. Okay? So, who do you think PVH's top competitors are? Who do you think they compare themselves against? Ralph Lauren. And every retailer wants to be L brands. That's Victoria's Secret, right? And it's not because of the hot fashion models. I mean, I'm sure some of them aspire to that for that reason. But it's primarily because L brands has amazing margins, right? So here's the thing. Let's look at the margins. And let's look at PVH. So I go to PVH. And I go to RV. And I go to the template that we just created, custom template. What is the formula for margin? I take my EV to sales and I divide it by my EV to EBIT. So for PVH, 1.4 divided by 12.16. So basically the market is expecting about an 11.5% margin going forward for PVH pre-tax. Ralph Lauren, 1.41, 11.67. The market is expecting a 12% margin from Ralph Lauren. L Brands. And this list, edit. Victoria's Secret. Here's Victoria's Secret. 2.33. EV to EBIT, 12.89. It's nice to be Victoria's Secret. 18% margins. So basically, if I'm PVH, what I see is that if I'm considering myself the high-end premium brand, I'm not getting the high-end premium margins. And I can clearly see that based on this is the expected level of margin that the market is estimating for these three retailers on a go-forward basis. Operating margins, EBIT divided by revenue. In plain sight. This is what they're using to value these companies. So how do I change my value? Start adjusting my margins. How do I get better margins? Separate story. Now, here's the interesting thing. Another feature of Bloomberg, supply chain. SPLC. This will show you the supply chain of any company. These are the customers of PVH, based on public data that Bloomberg's been able to get. Macy's, Kohl's, JCPenney, Hudson Bay, Walmart, Belk, Costco, TJ Maxx, Dillard's, Sears. Nordstrom's is in there as well. What does that tell you? Why do they have the lowest margins? Yeah,
Some of the retailers you went to aren't really like high end.
that's right. Look at these retailer lists. A lot of these, Costco, TJ Maxx, Kohl's, JCPenney. These are not your high-end retailer brands. So basically, they're going through these discount retailers. Premium brand through discount retailers, lower margins relative to their peers. This is what the analysts are focusing on with them. So again, it's not just can they raise price or cut cost, it's they have a channel strategy choice, which is their channels is going through a distribution channel that's lower price point. What's true about Victoria's Secret?
Charge a high price
Why?
because they sell it through their own stores.
They're through their own stores, and they control the brand, and they control the price, and they're able to charge price premiums accordingly, right? So again, if Victoria's Secret started selling things through TJ Maxx, people probably wouldn't pay as much for Victoria's Secret merchandise, because again, they're selling it through a discount retail strategy. So here's the interesting thing for PVH. Premium brand, these are their channel partners. This is the challenge their business has. They got to get their margins higher. This is what Wall Street's focusing on. How do they do this? What are they trying to do? Right? So again, I can't talk to you anymore about this, but the point is, all of this data is hiding there in plain sight if you know where to look.